Hello, agents. Hello, everyone, and welcome to Annuity Awareness Month, June 2024. Annuity Awareness Month. This month, today I'm going to talk about the joint life contingent. See the word contingent right there? Joint life and contingent annuity. So there's this lifetime annuity, but it's also contingent. It can reduce. It's contingent on someone's life. So as you can see, we're talking about the hunt. So let's just jump into it. The 10 years at 4.4 today, so it's down a bit, but and SPIA rates are down a tad for the month of June, FYI. So currently we're looking at the joint and contingent life immediate annuity. This is June 3rd, 2024, and this is the cost to fund $100,000 or $83.33 a month for two lives with inflation protection, and I also show without inflation protection of 2% a year, because inflation protection, anytime I talk to people, always bring up inflation. It's not inflation. There's totally a way to inflation protect your immediate annuity. So we'll get into that. It's just all about the cost, right? It's insurance, more premium. It's basic stuff. So as you can see here, so when one of them passes away, the primary in this case, the income would reduce 75%. So let's jump into this. So this is the no COLA and COLA, and these are the premiums required to fund this income of $83.33. It's 1.457 on the no COLA and 1.8 million on the COLA. So this is just some breakdown on how these illustrations worked. It's annuity income upon the death of the primary will reduce to $62.50 from that 83. Now on the COLA, it'll be higher. We'll get into that in a minute. All these payments begin 1 month after premium is received. The COLA increases by 2% compounded annually, right? This is all net. Everything you're seeing here is net, agents. This includes your commission, every internal cost of the company. So everything you see here is net after that. These rates are as of yesterday and are good for 14 days. This is an A-plus company. These rates are based on a non-premium tax state, blah, blah, blah. All that's done. Okay. So what are the numbers? So this is a reducing 75%. So it will cost $1,457,989 to receive $83.33 for life, right? With no less than 15 years. So here's what we have here. 265-year-olds. There's the premium. There's the income. There's your term, joint and contingent with 15 years. There's your minimum guarantee. See that? Minimum guarantee. And that's the payment amount should the primary die, right? What about the reduction? Well, the reduction is $62.50. But wait, you just said the minimum guarantee was 1.49. How is that? How do you know when they die? Well, this is guaranteed 15 years. And what it says that annuity payments are guaranteed for the lives of both annuitants or for a guaranteed period of 15 years, whatever is longer. If the primary annuitant dies before the end of the guarantee period, the contingent annuitant would continue to receive the payment for the remainder of the guarantee period. So basically what this is saying is the payment doesn't reduce for 15 years, no matter when that primary dies. So the 15-year guarantee says, hey, you're going to get that 100K for 15 years, no matter who dies. But after that, it could reduce. So after the guarantee period, as we read along, the payment will reduce based on the percentage selected for the remainder of their life. And you can continue reading this. It goes basically into more of those guarantees. So pause the screen there. But as you see, so your minimum guarantee of $1,499,000. Hold on, this mic's a little loud. Let me turn down. $149.99 is guaranteed, no matter who lives or who dies. So now let's take a look at the COLA. This is the one with the COLA. Same two clients. There's your premium. Of course, the premium's higher because it's a COLA. It's giving you some inflation protection. So you got to pay for that up front. I've done videos on COLAs and the break-even points, and you can look at those. I'll try to put a link in the description to those, or maybe in this video I figure out how to do that. But yeah, there's ways to figure out the break-even. So that payment's the same. It's the same contingent terms of 15 years. So that payment's guaranteed for the whole 15 years, increasing payment, right? Your total minimum guarantee is $1,729,000. So only will be based on the increased income, right? So that $62.50 is wrong. Of course, right? Oh yeah, I forgot all about them. One of the most important thing about immediate annuities is the exclusion ratio. So here, the exclusion ratio, assuming this is all cash money after tax, of these payments, 58.1% would be tax excluded anyway. So the total amount of payments shown reflect the annuity income will increase by 2% a year compounded on the anniversary date of the first payment. So that's how that works. So let's break it down I don't know if you have any other questions on this, let me know, but that's basically how it works. So this is the breakdown of the 2% COLA. And as you can see, this assumes no reductions and the primary annuitant lives the whole time. Because the way we set this up was at the primary annuitant's death. Actually, do we want to jump back into that? So it reduces 75 on the primary. You can make these reduce on either death. I just did the primary here because that's usually how it's done. Usually when the primary dies, you don't need as much income in the future. That's why we do the reduction on this on the spouse or the secondary. So that's why it was done that way. So let's look at year 15 here. The income would be now up to, and this is all the guaranteed, remember, the first 15 years, $10,000, and the income would be $131,000. So your total minimum guarantee is $1,729,000 or 96.04% of that initial $1.8 million premium, right? So at age 87 in the 22nd year, should either one or should the primary still be alive or both still be alive, your income has increased by 51%. So it's now $151,000 or $12,000 per month. So that's how the COLA and that's how inflation protection works. So you started with $8,300 and now you're at $12,000. So, and that's your monthly income, right? And you see the annual payouts there as well. So let's look at the next one. This is assuming the primary passes away in the first 15 years, right? So your first 15 years are still guaranteed with the same minimum guarantee, 96.04% of your premium, right? However, in the 16th year, since the primary died, we're going to reduce that payment. And I'm doing this to the most guaranteed side. So I'm actually taking the reduction off the $10,995, where it might not be, it might be the higher number, but I just want to show the worst case scenarios if it doesn't work good, right? That would reduce your income to, in the 16th year, the spouse's income to $82.46, right? Or $98,960, almost 99% of the original 100,000. So you're almost still at the original 100,000, even though it reduces 75%, right? So that's how that would work. And then that income would increase every year. Whereas in 87 years old, you'd be getting 11% more income than you started with, so at 111,000. So this is how the inflation and the reduction kind of help offset that premium cost up front. Whereas if you didn't do the reduction, it might have been well over $2 million premium. I didn't actually price that, I probably should have, but this is how this works. It's a contingent. So it only reduces on the death, on the primary in this case. So yeah, interesting. Not a lot of people. So let's look at if the payments were just level and no assumes a 25% reduction on level payments, right? So at the end of the 15th year, your minimum was guarantee is for $1,499,000, basically $1.5 million, which is 102% of the initial premium. So on this one, you're guaranteed you can't lose money, even if both annuitants die in the first 15 years. There's a guarantee, but if the secondary annuitant, primary died, the secondary is still alive, the income does drop to the $62.50 or $75,000, 75% of the 100 grand, right? And there's no COLA here, so it won't increase or be the 100,000. It's just level, right? But you did spend, a lot less money to buy the product. So 75% of the initial income, that's that. So here's some disclosures on the SPIA. So take a look at those, kind of break down if you had questions on those illustrations. Before, these are some basic disclosures there. Yeah, that's the end of my presentation. So anyway, welcome to Annuity Awareness Month. This is called the Joint and Contingent Immediate Annuity. So those can be dialed in. You just need to quote those a certain way. It can be at either death. It could be at the first death. Or the primary death. So either would be the first death, and then you can pick whether you want the primary to reduce or the secondary to reduce. So you can have a reduce on either one. That's the contingent part of it. And I'm all blurry and stuff, so I'm going to end up this video right now. We're getting a little long. Welcome to Annuity Awareness Month, May 2024. 800-373 for them. If you have any questions, there's my social media for the most up-to-date LinkedIn and YouTube. All that. If you have any questions, please just give me a note, leave a message. Leave a comment, like, share, subscribe, all that nonsense. So talk to you soon. Thanks for watching. Bye-bye.